You've heard about the stock market your whole life. It's on the news every night. People talk about it like it's this mysterious force that controls everything. And honestly, most people nod along, pretending they get it, but deep down they have no clue how it actually works. Today, that changes. By the end of this video, you'll understand the stock market completely. How it started, how it works, why it crashes, and how people actually build wealth from it. Everything you need. Let's get into it. So let's go back to the 1600s. Europe has just discovered the Americas. Trade routes are exploding and merchants are making serious money. But there's a problem. Sending ships halfway around the world is incredibly expensive. You need ships, sailors, food, weapons, and the whole thing takes years. And any day, a storm or pirates could wipe out your entire investment. One guy couldn't afford to take that risk alone. So the smartest merchants came up with an idea. What if instead of one person funding the whole voyage, many people each threw in a little money? Each person owns a small piece of the journey. If it fails, they lose a little. If it succeeds, they share the profits. Simple, elegant, genius. That idea gave birth to the Dutch East India Company in 1602, one of the first businesses in history to sell shares to the general public. Anyone with money could buy a piece of the company. And if they changed their mind, they could sell that piece to someone else. That's it. That's the first stock market, born in coffee houses and shipping ports across Europe. Now, the idea spread fast. Stock markets popped up in London, Paris, New York, Tokyo. As the world economy grew, people started investing in railroads, factories, oil companies, technology. The stock market became the engine of capitalism itself. So what exactly is a stock? Simple. A stock, or a share, is a tiny piece of ownership in a company. If a company has 1,000,000 shares and you own one of them, you own 1/1,000,000th of that company. You're a part owner. Congratulations! Now, why would a company want to sell pieces of itself to strangers? Because it needs money. Think about it. If you want to open new factories, hire thousands of employees, develop new products, you need capital. You could take out a loan, but loans come with interest and debt. Or you could sell shares to the public and raise money without owing anyone a fixed repayment. That's the deal. Investors give money, the company uses it to grow. If the company does well, investors make money. That process of a company first selling its shares to the public is called an IPO, an initial public offering. Here's how it works in practice. A private company decides it wants to go public. It works with big banks and institutional investors who get the first crack at buying shares. Then the company lists on a stock exchange, like the New York Stock Exchange or the NASDAQ, and now anyone in the world can buy and sell those shares. The New York Stock Exchange, by the way, has been around since 1792. Legend has it that 24 brokers gathered under a buttonwood tree on Wall Street to get things started. Today, it's where big traditional companies like IBM and Coca-Cola trade. The NASDAQ came later in 1971, and it's all electronic, no physical trading floor. That's where the tech giants like Apple and Amazon live. Now here's the key question. How is a stock actually priced? Who decides that Apple is worth $200 a share? The answer is nobody and everybody at the same time. Stock prices are determined by supply and demand, just like everything else in the economy. The number of shares available is the supply. How much investors want to own them is the demand. When more people want to buy than sell, the price goes up. When more people want to sell than buy, the price goes down. Simple in theory, extremely messy in practice. Because here's the thing. A stock price doesn't just reflect how profitable a company actually is right now. It reflects how profitable people believe it will be in the future. It's a marketplace of expectations, emotions, and predictions. And humans are not exactly rational creatures. Think about Amazon. It went public in 1997 and lost money every single year until 2003. 6 years of losses. And yet people kept buying the stock because they believed in where it was going. Tesla went public in 2010 and wasn't profitable until 2020, 10 straight years of losses. Investors didn't care. They were betting on the future. This is also why the economist John Keynes Maynard compared the stock market to a beauty contest. Newspapers used to run contests where readers had to pick the most popular faces, not the prettiest ones, but the ones they thought everyone else would find prettiest. The winner wasn't the person with the best taste, it was the person who best predicted what the crowd would think. The stock market works exactly the same way. You're not trying to pick the best company, you're trying to pick the company other people will think is the best company, which is why psychology matters just as much as fundamentals. So what actually moves stock prices day to day? A lot of things. Company earnings reports, new products, management changes, scandals, wars, trade policies, interest rate changes, a single tweet from the right person. All of these create waves of optimism or fear, and those emotions get translated directly into buying and selling decisions. Now here's where things go from interesting to dangerous. Bubbles. Bubbles happen when stock prices rise far above what the underlying companies are actually worth. How? Because of stories. In the late 1990s, the story was that internet companies would take over the world, and that story wasn't entirely wrong. We do have Amazon and Google, but nobody had any way to figure out which companies would actually make it and which were garbage, so investors poured money into everything with a .com in the name. Prices went to insane levels, and then reality caught up. The dot-com crash wiped out trillions of dollars. 300,000 tech jobs vanished. Companies that were worth billions became worthless. The problem wasn't the internet. The internet did change everything. The problem was that the story got so far ahead of reality that when reality arrived, the crash was brutal. And here's the scary part. When stock market bubbles burst, it doesn't just hurt investors, it can take down the whole economy. Companies go bankrupt, jobs disappear, pension funds get destroyed. The financial crisis of 2008 is the most painful recent example. A bubble in housing, amplified by financial instruments nobody fully understood, nearly collapsed the entire global banking system. This is why you'll hear people say the stock market is not the economy. They're related, but they're not the same thing. The stock market can be hitting record highs while wages are stagnant and most people are struggling. Between 2007 and 2016, companies in the S&P 500 spent more than half their earnings buying back their own shares to boost the stock price, another 39% to shareholders as dividends. That left very little for raising wages or investing in new products. Great for shareholders, not great for everyone else. Speaking of the S&P 500, you'll hear this term constantly, so let's break it down. An index is just a tool to track the performance of a group of stocks. Instead of watching the price of every single company, you track a basket of them and turn it into one number. The S&P 500 tracks the 500 largest publicly traded U.S. companies. The Dow Jones Industrial Average tracks just 30 companies it considers the most important. When people say the market is up, they usually mean one of these indexes moved higher. By the way, if this is clicking for you and you want more of this, the whole finance world broken down clearly every single day, go ahead and hit subscribe. That's exactly what this channel is built for. New topic, same clear breakdown every day. Okay, back to it. Now let's talk about how people actually make money from this whole system, because that's the part you're here for. There are essentially three approaches. First, you can be a long-term shareholder. You buy shares in solid, profitable companies and you hold them. Over time, the company grows, profits increase, and the stock price goes up. Some companies also pay dividends, a portion of profits paid out directly to shareholders. This is the patient approach. Warren Buffett bought Coca-Cola shares in 1988 and has never sold a single one. That kind of patience has made him one of the wealthiest people in history. Second, you can try to be an active investor or trader. You analyze companies, spot ones you think are undervalued or positioned for growth, buy them, and sell when the price rises. This ranges from day traders who buy and sell the same stock dozens of times in a single day, all the way to hedge funds moving billions based on complex strategies. This approach can generate higher returns, but it's genuinely hard. Most professional fund managers fail to consistently beat the market. Warren Buffett actually bet a hedge fund $1 million that in 10 years, a simple S&P 500 index fund would outperform their actively managed portfolio. He won comfortably. An index fund, by the way, just buys a little bit of every stock in an index. You're not betting on any single company, you're betting on the market as a whole. Historically, that bet has paid off over long time horizons. Third, you can be a founder. Build a company, own a large chunk of shares, and if the company succeeds, those shares become enormously valuable. This is how Elon Musk, Jeff Bezos, and most billionaires actually built their wealth. Riskier than buying an index fund, requires a completely different skill set, but the upside is unlimited. So what are the key things to actually know before you participate in any of this? Volatility is real. Prices go up and they go down, sometimes dramatically, and for reasons that feel completely random. If you can't stomach watching your investment drop 30% without panic selling, you need to account for that. Timing the market is a fool's game. Even professionals who do this full-time rarely get it right consistently. The strategy that actually works for most people is simply investing regularly over time, regardless of what the market is doing. This is called dollar cost averaging, investing a fixed amount at regular intervals. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, it smooths out the volatility. Understand what you own. Buying a stock because someone on the internet said it would go to the moon is not investing, it's gambling. Before you put money into anything, understand what the company actually does, how it makes money, and whether the price makes sense. All right, let's bring it together. The stock market started as a practical solution, a way for the Dutch East India Company to fund ships without one person bearing all the risk. It grew into the engine of the global economy, a mechanism that lets millions of people collectively fund businesses they believe in. The price of any stock is driven by supply and demand, which means it reflects not just reality, but human expectations, emotions, and stories about the future. That's why bubbles happen, why crashes happen, and why the market can feel completely disconnected from everyday life. Making money from it requires either patience, skill, or building something worth investing in. The stock market has created enormous wealth for those who understood it and wiped out fortunes for those who didn't. Now you understand it. That puts you ahead of most people. See you tomorrow.